regulations. And now it's time for me to invite on stage the speakers of this presentation. Everybody, let's welcome on stage. Firstly, the partner, EY India, Hasina, Chhil, and tax partner, EY, Keyur, Shah. Everybody, I want you all to please welcome them with a round of applause. That goes without saying. Thank you. Yeah, a little extra energy in the room always helps, you know. Okay,
Super.
over to you, presenters.
Thank you. Thank you. Good afternoon, everyone. So the topic, obviously for today is fintech regulations. And frankly, if you ask me, with all the recent activity in terms of the number of guidelines that are issued or circulars, notifications by the RBI for NBFCs, for payment system operators, I think a 30-minute slot or a 40-minute slot to discuss fintech regulations is going to be a little difficult. So we're just hoping that we're able to do enough justice to this. The idea was to give you at least a fair overview of what are some of the key regulations that impact fintechs, and obviously impact fintechs indirectly from a regulatory perspective because they are not regulated entities per se. But give you an overview of how fintechs would get impacted and try and take as many questions as we can. So with that, Keyur, over to you.
Thanks, Hasina. Just a little bit of introduction. Both of us are part of the financial services tax practice at EY. So that's us. So, if we just go to the first slide. This one works. Yeah. We've just tried to plot what we saw was happening within the fintech landscape in the recent past. So even if you look at the number of fintechs we've had here is more than 7,300. We are third after US and China. Interestingly, if you look at the number of digital payments which are happening, we've surpassed the whole world. We are much, much larger than even the US in terms of digital payments. So to that extent, we've made huge strides as an economy. If you look at the kind of funding which has happened on the fintech side, and if you look at payments which are being, fintech payment providers, more than $4.79 billion have gone into that space. InsurTech, which is another large space which is coming up from a fintech perspective, we've seen more than $820 million go there. And then obviously there's fewer players there. So on the newer banking side, around $180 million has gone there. And therefore, as we see the regulators also wanting to have far more play in this area. Obviously, as Hasina mentioned, there is no way they can regulate, or as of now, they don't regulate the fintech players because that would be beyond the remit of what RBI can currently do unless there is a change in the way they regulate stuff. And therefore, most of the regulations as we see today are being made applicable to the regulated entities, which could be therefore to that extent your NBFCs, banks, insurance companies, insurance intermediaries, so on and so forth. So that's how we are seeing the regulators trying to regulate in some form or shape this industry. If you look at the key guidelines which have come out in the last few months, one obviously, and where we'll end up spending a few minutes, is the digital lending guidelines, which the RBI released fairly recently. There is a lot of action, discussions we've seen around these guidelines. Before that, RBI released one circular around crediting wallets, where they've said that PPI players cannot directly credit the wallet of the borrower. You have to go through so that one thing which was changed. There were master directions which were issued on debit and credit cards. Again, RBI has so far only allowed 2 NBFCs to issue credit cards. Hopefully they will allow a few more. That was the idea behind the regulations. We have not seen any approvals come through so far, but these regulations are again out and we need to see how that pans out. Earlier or late last year, the PA, Payment Aggregator, Payment Gateway Guidelines came out. Right. Again, that is something which a lot of applications were made. There were few approvals have come through. We'll see again how that landscape evolves. There is stuff around the IFSCA, which is the gift city. So I don't know whether people would be familiar with this whole concept of gift city, but the government of India has set up a separate zone within Gujarat, and it is regulated by the IFSC authority, which essentially gives you the ability to have a dollar-dollar trading economy or trading system. And that is the IFSC authority. We'll try and cover that also a little bit in detail in one of the slides. Going to the first most important discussion point which we've been having as EY for the last few weeks is around the digital lending guidelines. Can I just take this?
Yeah.
So obviously there was a working group which RBI had set up, after which a press release was released, and then finally the guidelines came through. There were many aspects which impact the fintech ecosystem if you are in the lending business, which get covered by the digital lending guidelines. We've tried to highlight a few of them. Obviously, there is a lot of discussion which is happening around this, a lot of submissions which are being made by various stakeholders on these regulations, and hopefully we'll see some clarity. The biggest issue obviously, and which is the last point here, and we'll just try and cover it up front because that we've seen the most questions around, is on this whole FLDG piece. Obviously right now what the RBI regulations say is that the securitization guidelines as prescribed by the RBI would apply to all forms of FLDG arrangements, especially with the context of synthetic securitization, which makes it a little complex in terms of how FLDGs would work. Obviously the question which is asked at times is that therefore is RBI saying that is FLDG prohibited? At least our thinking as we speak today is that FLDG is not something which is prohibited. If they wanted to prohibit it, they would have said so. So therefore to that extent it doesn't seem to be prohibited, but it comes with significant amount of constraints. The other, and I'm not necessarily following the sequence here, issue which is there is with the context of sharing data. Again here the RBI is saying that all the data which is collected by the regulated entity would reside with the regulated entity. It can share certain data with the LSP, which is the service provider, but again the custody of all data has to be with the regulated entity. Also the kind of data which can be collected is restricted under the guidelines. It says that when you are granting the loan, there may be certain things like you need to access, like the camera of the person of the borrower, or the microphone of the borrower. Again, only a few things can be accessed. Everything else which you need to access or you need more data around, you please take the approval of the borrower. So that's what we are being told. Again, this stems from all the controversy which we were seeing around misuse and abuse of data collected when loans were granted. So it seems to be stemming from there. So they have significantly curtailed the access of data to the LSPs, and therefore they want the regulated entity, which could be your NBFC or the bank, to be held accountable for anything which happens around data. Also on loan servicing and repayment, what we are told now is that all loan servicing, in the sense all disbursement and recovery of loan amounts, have to happen in the borrower's account. Obviously, if you have a payment aggregator in between, then the payment aggregator can disburse a loan. But having said that, as far as recovery of a loan is concerned, again, there is lack of clarity whether a payment aggregator can get involved or not. There are certain exceptions, like for example, if you want to make a direct payment to the vendor's account, again, that seems to be something which at least we believe should be allowed. Because when you make a payment directly to the vendor account as a lender, you're not directly making a payment to the borrower's account, you're making a payment to the vendor's account. So it's different. But we think that some of these things should be allowed within the essence and the framework of the guidelines.
Some of these points were issues with the press release. Hopefully, after that, when with representations that were filed,
Right.
at least this particular point got clarified in the guidelines.
The other part on buy now, pay later, again, they've said that all buy now, pay later kind of transactions would need to be reported to the credit bureau. So that again makes it, the idea again seems to be that you are able to track what is being lent. Data is being reported to the credit bureau. So there is some method in this madness. So that is again what RBI seem to be wanting to do. I think we've covered all collection. Yeah, I think we've covered this. Hasina, you want to cover the next slide?
Do you want to take questions or take that at the end?
Should we do questions at the end or should we do
I mean,
questions?
Happy to just make
questions
interactive
now
if you
also, whatever.
think so.
Technically, we're doing it in the end, but if anybody has...
If anybody has questions on the digital lending guidelines, we are happy to.
Okay, super.
Okay.
All right. So moving to the next, the next set of regulations that impact fintechs. And again, this did cause a little bit of stir because there were fintechs that needed to revisit their models, their operating models, the business that they do, separation of activities in various group companies, etc. Is the master directions on credit cards and debit cards. Now, two aspects there. One, and that didn't come out by way of a regulation, but did come out by way of a letter by the RBI to a lot of non-bank PPIs that credit lines into PPIs are not permitted. And sorry if I'm going with the assumption that concepts of PPI is something that's known to the audience. But if at any point of time you want me to stop and explain some of this, please feel free to do so. So again, when they send this letter out to non-banks on credit not allowed or credit lines not allowed into PPI, and you would be aware that for certain entities, their operating model largely had to change because the model depended on the fact that there was credit line that was passed on into a PPI or a wallet. And to that extent, RBI's whole thinking around this was for a PPI. A PPI is more like a payment instrument and should be used as such. A PPI, especially in the form of a card, in a card form or a card factor, should not be the one that is initiating a loan transaction. And which is where they came out with this particular letter. Now, equally so what we're hearing is that, while this is only in the form of a letter and it's issued to all non-bank PPIs for now, what we do here is that there have been conversations with, some of the banks that did provide this facility to discontinue this product. And I think we all must have seen this in a lot of newspaper articles, heard that from a lot of industry folks, as to some of the banks get impacted as well. So that was one major change, especially from a PPI perspective that happened. Moving to credit cards and debit cards, the first point being on NBFC's ability to issue credit cards, because as of now, the law provides that banks issue credit cards, and that's almost without really getting, you need some specific approval, but largely banks are allowed to do credit cards. When it comes to NBFCs wanting to issue credit cards, necessarily has to be with a specific RBI approval. And to that extent, what Keyur mentioned earlier in the presentation is that there are two NBFCs, SBI cards and BOB cards, that have the ability or have an approval to grant or issue these credit cards, but the approval hasn't been granted to any other NBFC. And this has now been a while. And the regulation of NBFCs needing approvals was always there in the master directions. So to that extent, in the revised master directions, there isn't really a change. NBFCs still need an approval. The eligibility criteria for NBFCs still to get an approval is 100 crores. That remains constant. But what the RBI has done in these guidelines, which are applicable to banks and NBFCs, is brought out a lot of other aspects which were otherwise applicable to banks. So they've spoken about, how, say, for instance, the operational flow should work, how the collection of data should work, how closure of cards should work, what kind of charges do you charge, etc. So they've brought out a lot of these aspects now in the regulations. So we are hoping, we are aware again that there are some NBFCs that have already filed an application. We are hoping to see, some approvals come through, but, obviously that depends on the entire scrutiny and due diligence by the RBI. So one is that on the critical aspect. The other critical aspect that was brought about in these regulations was the role of a unregulated entity, especially when it comes to co-branding of credit cards. So co-branding of credit cards, if it's between an NBFC and a bank, then that again needs RBI approval. And in the regulations, it's very specifically mentioned what should be the role of the NBFC and what should be the role of the bank. But when it's an unregulated entity with a bank that's, co-branding and issuing the cards, that does not need an RBI approval. But what RBI has reiterated in these guidelines, and, this time to be strictly followed as well, is the role of the unregulated entity. So they've said that the role of the unregulated entity has to be limited to marketing and distribution of these cards, and to that extent minus that initial point of contact that the unregulated entity has with the customer. Post that, there should be no services that are to be provided, and there's no involvement of those unregulated entities in these transactions, credit card transactions, should not be permitted. So, it should kind of be divorced. The unregulated entity does the marketing, does the distribution, but post that is not involved in any manner. And to that extent also restricted the data sharing and data storage. So today, if I take a co-branded card, the co-branded partner, which is the unregulated entity, may not really get all the information on my usage of the card. Now, obviously, to some extent, that's essential because there may be cashbacks, there may be refunds, there may be, other offers. So RBI said that is kind of fine, but otherwise, transaction-related data between the co-branded partner and the bank is to be restricted. They've spoken about storage also not being permitted, so that's again an important criteria. Some kind of screening between the two parties. So today, if I have a particular app where I'm required to, I would ideally want that when I log on to that app that I can see all the transactions that I have done. Some bit of that may potentially be permitted, but otherwise no sharing of transactions or storage of information. So what this has resulted in, if you largely see, is for people to relook at their operating models and see if there's a better way to do it. Do it in a manner that, what is the ideal way to do the business? Do you use a non-card factor? Do you have point of sale credits that are available by way of tie-ups with merchant aggregators or even some of the fintech partners? Because again, any kind of credit into the credit cards or until an NBFC has a credit card license, that is now made fairly restrictive by these guidelines.
Next slide.
Yeah. What we've covered on this slide is largely again for fintech entities, and like we've been discussing, fintechs per se are unregulated. They're kind of indirectly regulated because they work with regulated entities. So they are required to comply with any of the outsourcing guidelines because the NBFC or the PSOs would need to comply with it. They do comply with code of conducts of banks and NBFCs, but not directly regulated. But at the same time, a lot of fintechs and a lot of conversations that we have with clients is fintechs wanting to move into the regulatory space as well. So say for instance, a fintech wanting to get an NBFC license to enable them to do the lending as well, or fintechs wanting to get into the payment system operator license, which could either be say payment aggregators, which could be PPIs, which could be WLAs, the white label ATM and the likes. So what we've tried and covered here is two aspects, one from the FDI policy and the other is the current approach of the RBI, especially from an NBFC perspective. So what RBI basically did is, or rather maybe I'll take the FDI point first. FDI, foreign direct investment into a regulated business is 100% permitted under the automatic route. So an investment, foreign investment into an NBFC or a PSO, that is fine, that does not need a government approval, unless the aspect that we've mentioned is that if the investment is coming from a country which shares land border with India, China, for instance, and again, we've heard enough buzz on that. So any investment that comes from China into an entity, whether regulated, unregulated, otherwise, needs government approval before you actually can make the investment. Fortunately, and while it did take a while, but we are now seeing approvals come through. So that's one. Two, that if you are making the investment in a financial services entity, but which is unregulated. So just maybe as an example, let's take a situation where you are an NBF, where you do carry out some kind of loans, but you don't meet the 50-50 test, for instance. And to that extent, any investment that's coming in. So say, for instance, if your loans is more like a treasury function, not really a business activity, and you have some investments that are coming in this entity, because you are also carrying out some kind of unregulated business in that particular entity, but you otherwise don't need a regulated license, so you are a non-NBFC, then the guidelines do provide that you have to go to the government to get an approval before the investment is made. And so to that extent, the guidelines provide for both. Regulated entities, 100% is allowed. Financial services activity in an unregulated entity needs government approval, or if it's investments that are coming from countries that share land border with India. The second aspect that we've tried to cover here is where you talk about any payment system operator or NBFC, so any regulated approval that you need. What RBI has provided by way of notification is that any investment of more than 20% that's coming in from a country which is a FATF non-compliant jurisdiction. So currently, if you look at some of the non-compliant lists, it'll be the likes of Philippines, Cayman Islands, Mauritius was in the grey list, but now it's out of the grey list, or even Dubai, so UAE as well. Yeah. So if there is investment that's coming into a regulated entity, which is an NBFC or a payment system operator, directly or indirectly of more than 20%, then that's not permitted. Unless you're an existing regulated entity and these are your existing investors, then more investment is fine. But otherwise, if you are not an existing investor, not an existing regulated entity, more than 20% is not permitted. So that's an important criteria, because again, with a lot of NBFCs especially, or even PSOs, what we've seen is that we have some of these large private equity funds that make investments, and some of them do have their pooling vehicles in Cayman. So to that extent, it's important to see that where we are looking at an NBFC or a PSO license, who our investors are not only the immediate investor, but right up to the ultimate beneficiary. So that's one point. The other point, and that's more like an unsaid rule of the RBI, but we've seen them apply that pretty consistently across applications, is that where you have foreign direct investment that's coming in, RBI now wants to, and earlier as well, but they do wish to do a diligence on every large shareholder in the company. So for every large investor, and again, there's no prescribed limit of large, so we may think, okay, 50% is large, RBI may think probably even a 20% more could be a substantial investor. So for every large investor that comes in, especially if it's foreign, RBI would want the foreign investor to either be a regulated entity or be a listed company. And if it isn't, then RBI's ability to do diligence on that investor is restricted, because it's a foreign entity, right? You don't have, as RBI, they do not have too much data around that entity to be able, data that they can gather around that entity to do diligence. And so in absence of being able to do diligence, we've seen a lot of applications that have got, I wouldn't want to use the words rejected, but returned in RBI parlance. So again, that was the other aspect that we wanted to cover here, that, especially for fintechs that are looking at broad basing into either an NBFC role or a payment system operator loan, these are aspects that we need to take care of, or we need to evaluate from a structuring perspective before we kind of even bunk in the application.
Yeah. Sorry, I'm very conscious of time. So we had 2 slides left. On the whole IFSC piece, again, As I said, it is a area where if you want to expand out of India, because of the fact that there are a lot of fintechs which want to have a global footprint now, you could possibly set up something in this IFSC zone. You enjoy a 10-year tax holiday. They have a separate regime for fintech entities, including a regulatory sandbox approach there. The interesting part there in the regulatory sandbox is that they will allow you to touch clients as well. 10-year tax holiday and zero GST. So makes it fairly interesting from a expansion perspective. And a lot of fintechs are looking at doing something there, more on the trade settlement side, on the software development side, again, if you are looking at overseas markets. So that is one thing. Going to the last slide, again, this is more in terms of just way forward. I think a couple of points which we both wanted to cover. One is obviously if you are a fintech operating in this space, we need to relook at or maybe relook at your operating model, because one thing is very clear that the RBI is wanting to regulate how lending happens, what kind of data is shared, who is sharing that data, who has control over that data. The points which are also clearly coming out in the digital lending guidelines is all data has to be stored in India. It cannot be stored outside India.
Yeah.
So, that is something which is again very important.
And a lot of this is, obviously emanating from complaints that RBI has received, which if you go by the data, RBI has actually said that in the last couple of years, the number of complaints that they've received has substantially increased. They have other ways in terms of, the ombudsman scheme and all to receive these complaints. So both the digital lending guidelines to a fair extent and especially the master directions on credit cards that came out, RBI's point was that customer, just from an overall governance perspective, customer protection, data protection, so the protection of the data for those customers, or otherwise how do you deal with customers, some things that otherwise were happening automatically but now need consent. That's actually been the focus of the RBI. So that results into, from a way forward perspective, of us needing to relook at the arrangements that we have, the agreements that we have, some of the security aspects that we look at, especially from a data perspective.
Yeah, I think we are completely out of time. Any questions? We are happy to.
We're fairly clear. So we kind of needed to rush through, which is why I said that 40 minutes, 30 minutes, 40 minutes is.
Yeah, hi. This is Arun from RainPay.
Hi.
On the guidelines that came, there is a lot of talk in the industry about FLDG, and I thought, I don't know, maybe you have discussed this earlier, I came in a little late, but if you could throw a little light on that.
Yeah, so we thought we'll take the elephant in the room first, so I covered that as we started. But anyway, Arun, I think...
My mistake.
No. So we'll just try and, in a nutshell, it is what it is. There is significant lack of clarity right now in terms of what the RBI seems to be wanting to do on the FLDG guidelines. As I said, a lot of representation is being currently made on what is the intent behind the FLDG guidelines, the way they are being spelled out currently. Having said that, of course, some basic things seem to be clear, that if you are doing a FLDG on a pooled basis with the specific reference to synthetic securitization, pooled FLDG may be an issue. Having said that, there are other open questions on terms of what kind of framework do you operate within two regulated entities or one regulated, one non-regulated entity. So we are having discussions with various stakeholders, but the hope ideally is that the RBI will give some form of clear guidance around it. As we speak today, again, the basic question arises, is RBI saying we should not do it? At least to that extent, our view is that it's not that you should not do it, because otherwise they would have, they would have said it, right? That is the easiest thing to do. No. So at least they are not saying no. But we have this whole overlay of securitization guidelines with this digital lending guidelines. So everybody is trying to decipher what the elephant is. And each person has his view. So hopefully the RBI will tell us that it is the elephant and tell us what to do with it. But right now it's a little grey.
Yeah.
Sure. Yeah, we are. I can hear you.
So look, the guidelines say that by November 31st you have to comply. 30th
Correct.
November you have to comply.
Correct.
We hardly have any time.
Yes.
Right? If RBI
In fact-
does not come out with any clear guideline, then we are all
No,
in-
For new loans,
RBI, the guidelines say for new loans it is applicable today.
It's for existing
Yeah,
loans that
for
you have.
existing
to- the
So it
30th
it is
November.
already,
Yeah.
so theoretically it is already applicable.
Yeah.
But hope is that they are looking at it more holistically, right? So that by November 30th, you should apply it. So again, we are hearing some discussions that RBI may be doing some closed door meetings, etc. Don't know fully the details, but hopefully we will get more clarity on this one as time progresses.
Because and I'm sorry, I'm continuing on that, but FLDG, the whole intent is that there is no systemic risk. And as I understand, some of the FLDGs in the industry were not really backed by cash. They were just guarantees which
True.
were given.
Correct,
Yeah.
correct.
But if you have an FLDG structure which is actually backed by cash, do
Yeah.
you think RBI will be open to something like that? I know there are discussions going on, but
Yeah. So the worry which RBI has, and Hasina, please add, is that, how do you control that? I mean, they are not going to be able to say that, okay, as long as it is a cash-backed FLDG, you are okay, because they are not able to regulate the non-regulated entity, right? And how that non-regulated entity is leveraging, where is it getting its cash from? RBI is completely blind to that whole aspect. And because RBI is completely blind to that whole aspect, there is nervousness around it,
Yeah.
which is why I think it is becoming very, very fuzzy here.
Yeah. And if you see the, the working group report also, and they came out with these concepts of rent a license model and the like,
Yeah.
and that actually had in the illustration in one of the annexures, more details around how that transactions run and the whole service delinquency, etc. So RBI's point is, like Keyur rightly mentioned, the nervousness around this. But again, even if you have a cash collateral, they may still conceptually not be okay with this rent a license model.
Yeah, correct.
Because
they-
in their
yeah.
minds, it's only a regulated entity should be allowed to do the lending function and not more. And historically also, if you see, the FLDG model has been continuing since years. But obviously, it wasn't a situation where there was cash collateral that was maintained or 100% FLDG. But banks used to, tie up in partnerships with other entities and do
do this,
FLDG.
yeah. I think
It's just with the amount this
Volume.
has, frankly, from a volume perspective, picked up in the last 2 years, the amount of complaints that RBI has seen, certain unfortunate events on the whole recovery models and aggressive recovery mechanisms being adhered to by certain fintech players. That's caused this entire, if I may call it, uproar to say that this is something that we should not permit. But RBI has not come out and said it in so many words, but if you look at aspects of the securitization guidelines, and again, difficult to say what really applies and what doesn't, because they've unfortunately left it to our judgment on what applies from the securitization guidelines or not. But there are aspects. Pooling, I think, is pretty clear that synthetic securitization should not be permitted. Then it also talks about maintaining an additional capital charge equal to the actual exposure, which is almost 100%. So it's not only your 15% CRAR that you need to maintain, but almost 100% needs to be maintained.
So basically,
as
it
a
goes out
capital
of your
charge.
tier 1 capital.
So it goes out of your tier 1.
Which then makes it even more. I mean, then why would you do it?
Yeah. So they brought out, some of these aspects just by making that linkage to securitization. So kind of making it difficult and to some extent maybe a little unviable business-wise, but not saying it in black and white, unfortunately.
So yesterday in the same forum, Shaktikanta Das mentioned that about the FLDG,
Yeah.
that he is going to come out
With
discussing. They're going to come
clarifications.
out with the clarification.
Yes.
They've got this feedback
Yes.
from all of us.
Yes.
Yeah.
And they're working on it. They are
That's
yet
correct.
not clear. He was very clear about it. He's not clear.
Yeah.
And he
It's
said,
actually surprising for the RBI governor to say,
no, he was not mincing words because he
Yeah.
was very clear that
Yeah.
I am not clear because there are so many vulnerabilities
True.
around it.
Yeah.
And there is so many possibilities around it.
Exactly.
So which way we'll go, we don't
Yeah.
know right now.
Yeah.
But we'll come back to you by 30th.
Yeah.
But which is why, if you see the genesis of this whole thing, first they said that we will have a separate, if you look at the press release, they said we will give detailed guidelines later. But then suddenly, God knows
In
what
the
happened when the guidelines came
yeah.
out. It came out in this form.
Yeah.
So again, I don't know what the whole hurry was on this, but I mean, we are where we are.
The reality is that some of the NBFCs were taking FLDG from fintech partners where the balance sheet was not considered. They were into losses and there was no cashback guarantees as
True.
such.
Yeah.
So that was an
But-
issue. I
Because
guess.
But
it
that
creates
is-
a risk
yeah.
systemically.
That is the
So,
story with our
yeah.
regulator on all regulators, right? One small rotten apple will then decide the fate of everybody in the basket. So yeah.
But I think enough and more representations have been made. In fact,
See.
we are filing a few more. No, I was just saying that we are also with all the representations that are being made, expecting
Hoping that.
RBI to come out with
I think
clarifications.
we are all in interesting times.
True.
Yeah. I think what needs to be seen as the clarifications kind of clearly mention it in black and white or lead to further open-ended questions, but let's see. Cool. Thank you.
Any more questions? Done? All right. Thank you, Hasina. Thank you, Keyur, for this insightful presentation. Can we have a round of applause for our speakers, please?